Hello and welcome to Rebank. I'm your host, Will Beeson. Regan Bozman is co-founder of Lattice Capital and an expert in token launches and secondary trading dynamics. Lattice is a crypto-focused VC firm managing $80 million across two funds with a focus on early-stage projects. Prior to founding Lattice, Regan and his partner Mike worked at CoinList, a leading platform for new token launches, operating since the ICO boom of 2017. In this conversation, Regan and I discussed the current state of retail crypto trading, various interpretations of Memecoin energy, lessons for building community with airdrops, tension between VCs and retail token investors, managing a venture fund in a narrative versus fundamentals-driven market, the rationale for LP allocation to crypto, and more. Thank you very much for joining us today. Please welcome Regan Bozman. Regan Bozman, welcome to Rebank.
Thanks for having me on.
It's great to connect with you. I'm excited for this conversation. We've had a lot of discussions recently with Web3 crypto investors. You, I think, have some particularly unique views based on interactions we've had, the content of yours that I've perused on Twitter and elsewhere. So I'm looking forward to this conversation.
Thanks. Hopefully it's not too outside the box, but yeah, I'm looking forward as well.
So maybe we just jump into the meat of it. Right now, meme coins are having a moment. We'll see how long that moment lasts. Maybe it'll be a long one. What do you make of meme coins as a crypto VC, but also as someone who I think has been very close to token launches for many years now?
I think meme coins are fascinating. Like, it's not a new concept. I think one of the first tokens to hit any kind of real mainstream adoption outside of Bitcoin was Dogecoin, which I think came out in maybe 2014. I think it actually predates Ethereum and was kind of ironically like launched as a joke to basically show how dumb Bitcoin was. And obviously that joke kind of backfired because it's now like a multi-billion-dollar token. But look, I think memes and the attention economy we see on the internet today has been around for a decade, probably longer. People have been betting on sports and generally for thousands of years. So I think meme coins are kind of like a natural evolution of marrying those trends. And they're fun, right? Anyone can spin up this permissionless betting market, whatever you want to call it. I think that's really cool. And it shows the power of the internet to enable kind of this permissionless innovation. Now you can just say, okay, like you're betting on whether the price of a picture of a dog is going to go up or down. And that's not wrong. But I think you could look at the lottery and say, okay, you're like entering this thing where the odds are rigged against you. That is also dumb. And you also would not be wrong in that. So I think it's kind of a very natural human thing to want to bet and try to make money with your friends. And this is a natural extension of that. So I think in and of itself, they're very interesting. I like them. I like texting my friends about them. But I think their relationship to crypto venture right now is very interesting because they have sucked some air out of the room in terms of just the desire of people to trade on random tokens. And so I think that is why you see like a lot of crypto VCs talking about them today.
Right. So to that last point, the meme coin's relationship with crypto VC, basically what I heard you say there is from a cultural commentary standpoint, very interesting. An expression of humanity and parallels in all sorts of other current and historical human behavior. But as a crypto investor, do you look at meme coins and say, this is great because there's on-chain volume and price volatility, and this brings more capital on-chain as people try to take advantage of financial opportunities? Or are you saying we're watching and waiting right now because ultimately we think something of more durable long-term value is going to be built off the back of this? How do you translate what you see happening in meme coin energy right now with the decisions that you make as an investor?
I think one of the most interesting parts about blockchains is you can't really control what people do on top of them. And so I think meme coins have been born out of a lot of innovation to happen over the last 5 years, specifically meme coins in their current form. Solana is fast and cheap, and it generally works. And you now see actually a lot of beyond that kind of core technical infrastructure, which I said in 7 words, but that's the result of dozens of engineers working over the last few years to really build that product. Now you have things like Pump.Fun and Birdseye, which make it very easy to like launch meme coins, to monitor contracts. The like DEX product suite on Solana for trading these assets has gotten very good. Phantom is an awesome wallet experience. You kind of needed a lot of core innovation to make the experience of trading meme coins on chain get to a point where it's actually like really accessible. So I think, VCs can complain about people are focusing on this silly stuff and they should be focused over here. I think it's a wrong way to look at it. We funded all of this infrastructure and people are doing what they want on top of it. And it happens to be this thing. So I don't think it's right or wrong. I think it's what people want to do. I think that it is kind of the current meta of this cycle. I don't know that it's onboarded a ton of new people into crypto. Trading these assets is still kind of crypto native. You need to buy SOL, you need to move it to a DEX. A lot of times, if you're like looking at something like Birdseye and monitoring contracts for new token launches, it's not that intuitive of a behavior for most people. So clearly a large base of people are trading meme coins today. I haven't seen data to suggest that 1 million new people, as an example, have come into crypto to do this. I think it's still a small base of traders. Now, I think that base will grow because I think meme coins are fun. And I think meme coins tied to current events are really fun. So one current trend people have been talking about is the Olympics is coming up in July. And there's now all of these country coins. There's like an American coin. There's like a French coin. And in addition to like betting on track and field, you can bet on the meme coin of either your country or the country you want to support, or just the country whose like token you think is underpriced. So I think the addressable market for meme coins will continue to grow and it will onboard new people. Do I think that that's enough to really 100x the crypto market? No. Maybe part of the frustration amongst VCs about meme coins is this is just like a pit stop. This is not really where we need to go as an industry. I don't really disagree with that, but I think probably the end result of if crypto gets as big as we all think it's going to be, there's going to be a bunch of different things that people do on chain, and punting on memes is probably going to be one of them.
Meme coins to me seem, or rather the behavior around meme coins, the interest around meme coins seems to be quite similar to what we're seeing in the broader airdrop side of crypto. And it makes sense, right? If we kind of rewind to how this quote unquote cycle, tokens started to pump, including Bitcoin and Ethereum, maybe 6 months ago now. And there was a lot of enthusiasm around basically upward moves in token prices. That naturally translates into not only, I guess, what we've seen this interest in meme coins, but also interest in projects taking advantage of strong prices to look to theoretically lock in ecosystem, using tokens as a way of building ecosystem. And airdrops are a classic way of doing that, basically rewarding early users with free tokens. But the airdrop landscape at this point seems, I guess, to an extent played out. I think it's not clear anymore that that's the strongest way to build community. And in fact, it feels like most people are looking to, quote unquote, trade airdrops or farm airdrops in the same way that they're looking to trade meme coins, which is really captured short-term value versus engaging as part of a broader community. Do you see similarities between meme coins and project tokens? And do you have any thoughts on the airdrop paradigm and how you expect that to evolve?
Answering the second question first, the way people have done token sales token launches more broadly has changed over time. You go back to 2015 in the Ethereum ICO, maybe it was 2014, but around that era. And it was basically like just anyone could send Bitcoin to this address and get ETH back. KYC wasn't a thing. You could do this as an American. Like there weren't a ton of rules. And then you moved to the 2017 cycle and you'd send ETH to an address and you get back some ERC20 tokens. And again, it was like relatively permissionless. And then you kind of fast forward to the way a lot of the L1s launched, like Solana, Near, AVAX, 2019, 2020. And that was kind of moving towards compliance was more of a thing. People were using platforms like CoinList, where I used to work. Slowly, these things got more restrictive. At first, you wouldn't let Americans participate, and then you wouldn't let Canadians and Chinese participate, just as kind of restrictions got tighter globally. So the way people launched tokens has changed over time, but generally it was I trade you money for a token. That started to get a little bit divorced over the last 2 or 3 years. I think partially, one, just because of more regulatory scrutiny on the space. And so people generally getting hesitant to sell tokens to the public, but also a result of just a lot of money going into crypto venture. And you did need to get your token in the hands of the community, but you didn't necessarily need to raise more money because you could raise a bunch of money in private markets. So teams just doing airdrops and never raising money from the public became more prominent. So Uniswap is a good example. They did this big airdrop in, I believe, summer 2020 and kind of helped kick off DeFi summer, but they never raised money from the public. And then Blur kind of took the airdrop model on its head and said, like, rather than just like retroactively reward people for what they've done, why don't we actually like actively incentivize them for certain behavior that we want to see over a long period of time? And so Blur, starting probably a year and a half or 2 years ago, basically just started incentivizing people to use their core product, which is like an NFT buy and sell marketplace. And people would basically earn points for doing that. And you weren't really sure what amount of tokens your points would translate into, what dollar value that was worth. But it was a much better mechanism to directly encourage the behavior you wanted over an extended period of time. And they did that really well. It was a somewhat obscure project 2 years ago, and now it is clearly a top 3 NFT marketplace. And like everything in crypto, once someone does something that works, everyone else does it. Then you eventually saw, fast forward to today, every project, a core tenet of their go-to-market strategy is some kind of points campaign converting into an airdrop. And I think that in general, rewarding early users of a product with like ownership in it is much better than the paradigm that exists today in traditional software. I am a big fan of it, and I think this is very core crypto ethos. But if that's the only way that people can ever earn upside in your project, I think that it's bad. And part of that is because the way people have tried to game these systems is you're giving people basically money denominated in tokens. How can you give people the most money but give away the least tokens? Because generally you have a fixed token supply. The answer is you maximize the value of the tokens. And so what we've seen is kind of a paradigm where all of these projects want to reward their communities with the highest dollar value airdrops. And so that leads to these projects launching at very high fully diluted valuations, in my view, in a way that kind of means they can really only go down from there. The way that you generally can juice your FDV is by having a really low circulating supply. So there's just not a lot of natural sellers on day one. And so you can maybe launch with like, let's just say 8% of tokens circulating, all of the other tokens are locked. And you can kind of go out at a high FDV. Now, the two issues are like, one, if you launch a high FDV, your early investors have made a lot of money on paper, and you're setting up a scenario where as their tokens unlock, they are going to sell them because they need to return money to their investors. The second is you create a scenario where there's not a lot of natural buyers for these tokens. Now, if you've been doing a points campaign for a year, your early community, people excited about the project, they've been participating in it. You look at Eigenlayer, for example, which sort of has pioneered this like restaking idea on Ethereum. Most people who were excited about Eigen put their ETH in Eigenlayer. They've been earning Eigen through the points campaign and then through the airdrop. That tends to be like a pretty large part of the addressable market of people who would buy your token. And so you kind of like taken the core group of buyers and actually just given them this asset for free. And so I think it's just created a really bad, unsustainable paradigm where people are just launching these tokens in a way that kind of makes them go down only. And you asked about the similarities between airdrops and these, people call them VC tokens. I think the biggest similarity is that most market participants want to make money. And I think most people trading crypto assets want to make money. And I would wager that for 9 out of 10 of them, if you're trading a meme of Joe Biden or if you're trading Solana, your goal is the same. You want to have more money in your bank account tomorrow than you did today. And so I think the rise of meme coins and how easy they've gotten to trade, it's just given people this alternative venue where your investment desire is like, I want to make money. The meme coins are a very pure way to do that. There's not even like a story around oh, this is this next generation smart contract platform. It's like, no, this is a meme of Joe Biden. If you think more people will buy it today than will sell it, then you'll have more money in your bank account tomorrow.
That all makes sense. It is pretty clear to me that the hyper speculative energy in the market right now, perhaps fueled by meme coins or perhaps fueling meme coins, is also resulting in a highly speculative approach to airdrops and response to handling airdrop tokens once you get them, versus the goal, as you were saying, for most projects, which is to use the airdrop as a way of cultivating a community that's going to be long-term committed to the project. Would you disagree with that?
No, I think it's generally right. And look, I think there's cynical ways and non-cynical ways to look at this. And I think there are really strong early communities in these projects that want to see them succeed and are willing to put in time and risk the crypto assets they have to help these projects succeed. And so I definitely think those groups of people should be rewarded. I just think the way that people are launching these things today kind of doesn't really benefit anyone.
Picking up from there and making it very tangible, you at Lattice are investors in many great projects. What would you advise a portfolio company that is trying to build community at this point? Maybe someone that's even been preparing for a token launch. Is now a good time to do an airdrop? Or would you advise them to think twice about that, perhaps be more thoughtful in how they might want to build community?
So the tough part about the current paradigm is it's kind of like a prisoner's dilemma. Once your competitors are doing airdrops, you kind of have to do it because projects that offer similar value proposition to yours, people are going to make money if they use them. So, well, I would love it if I could snap my fingers and we'd all move past this. That's clearly not going to happen. So I think it's less that projects shouldn't do airdrops, but I think to me, the biggest issue with the airdrops is distilling down to like, you're basically capping retail participants' upside in what you do. A very tangible example of this is Solana launched their protocol on CoinList in March or April of 2020. And anyone on Earth, assuming you like lived outside the US, could have bought that token for 22 cents. And today it's about $145. You made a lot of money if you participated in that sale. You could have turned $1,000 into like 650 grand. That's wild upside. And that was like the best one. But there are a lot of primary offerings where people could have made a lot of money. Most of these airdrops are kind of denominated based on what you put in. So for example, Eigenlayer is more or less linearly correlated with how much ETH you put in. And so basically like one, you need a lot of ETH to go into that. But also because the way the airdrops are designed, you're generally just putting your assets there temporarily. You're kind of getting maybe like a 20 to 100% APY on those assets, depending on how much the token ends up being worth. Now that's good. I don't think anyone is going to complain about that, but that's very different from the potential for like a 500x on your money. So to me, like that is the biggest issue, is you are taking a very important group of market participants and you're capping their upside. I think the obvious answer to do that is to sell tokens to the public, which definitely carries some regulatory risk. And I'm not a lawyer and no one should take my advice on this, but you look at a lot of the largest projects today, they did these types of public sales. They are still alive and kicking, at least to my knowledge, and what's announced publicly. It's not like there's a bunch of SEC lawsuits against all these companies. So I think that creating ways for your early community to buy into your project and kind of uncap their upside, that's really how you get a strong community. So I would encourage, and I do encourage our companies to explore the options available to them to do this.
Yeah. Maybe that gets to this question that feels very relevant in the market right now. So there are people that are paying for tokens, and those are generally VCs. Those are the people who projects do feel like they have enough legal certainty to sell tokens to. And then ultimately, what that creates in terms of dynamic is VCs perhaps surely entering at a lower price than what's maybe ultimately airdropped or a price at the time of retail distribution. That obviously makes sense. They're taking much earlier stage risk. But unlike in private equities, there's quickly a market for tokens as soon as vesting schedules or lockups expire. And then the end result appears to be that VCs are basically selling tokens at a large gain to consumers through exchanges who aren't perhaps then necessarily realizing the same sort of upside that they would want to. Firstly, do you feel like I characterized that correctly? And secondly, what dynamic does that create?
I think that is an accurate way to describe the market. I think when you just frame it as like, oh, it's VCs and they buy these tokens at a low price, and then retail is kind of the terminal liquidity of them, it is an accurate description. I think it kind of sounds like a little bit predatory, which I don't think it is. Retail is like the largest buyer in the end of these tokens because there is not much institutional liquidity in liquid tokens.
Same in equities, right? Same in any venture segment.
Yes. The market functions like this just because not a lot of institutional money has been allocated to liquid tokens. And I think that is starting to change. And hopefully it changes more because these markets would be healthier if there were a lot more institutional participants on the liquid side. I think this story is also not as simple. Yes, VCs generally pay a lower price than whatever notional value people are getting the airdrop at, but they're also generally taking a much worse liquidity profile than retail participants. When we back a team on day one, the token generation event can be 6 to 24 months away. And then our tokens generally vest over another 3 to 4 years from that. So, it could be a 7-year period before we have all the tokens that we bought, which is very, very different than the average person trading on Coinbase. So I think that people who complain about this market structure, they also would probably not want the liquidity drawbacks that we have. I also don't think it needs to be PvP. If you look at a lot of the launches from the last cycle that did really well, Near, Solana, Avalanche, the public sale price was higher than the last VC round, but it generally wasn't that much higher. And partially because all those tokens went out at less than $1 billion FTV, sure, VCs were up on that, but everyone made money. The retail buyers of those public sales also did really well. I think what's challenging is, look, ultimately there's a market price for everything. It's not like projects can say, oh, I want to go out at $1 billion or, oh, I want to go out at 10. But there are levers they have to pull. And to the extent you can go out at a lower fully diluted valuation and retail participants can do better, I think that's better for everyone.
Traditionally, venture capitalists are taking more risks. They're investing in private companies at an early stage. If the companies fail, they lose their money. If the companies are successful, then ultimately different types of capital providers come in at different stages and invest with different risk profiles. And ultimately in great companies, everybody, including retail investors who buy at IPO or beyond, end up making money. That model is driven by fundamental value creation and specifically, I guess, valuations of businesses that are rooted in the fundamentals, i.e. the ability to generate revenue, marginality, ultimately net profit. Versus the current market in crypto, and if we kind of take it back to Memecoins, I think you used the word tension at the very beginning. Market pricing and therefore returns for investors, speculative investors, are driven as much by tension as they are by fundamentals. Do you want to unpack any of that for us and also talk about how it influences your thought process as an investor?
Absolutely. I think the crypto markets change the way traditional markets work on two axes. One is the assembly line of market participants is just dramatically shortened. Yeah, there are some Series Bs that happen in crypto, but for these protocols, there's not really growth rounds. There's not really private equity investors. And so you basically have VCs, maybe seed, probably Series A, occasionally Series B, then token launch, and then retail. So it's just a much shorter assembly line, and there's just much less of a buffer between venture capitalists and retail investors. And you definitely don't have investment banks in the middle the way you do in traditional IPOs. The second axis that the market has shifted is just what do you value? A lot of these protocols actually do make cash, and there are very good data platforms like Dune Analytics and Token Terminal where you can see the cash flows from these protocols. It's generally like not the way the market seems to value them. A lot of it is just narrative driven. For example, like most AI related coins are up maybe 500% in the last 12 months, despite like pretty limited usage across most of them and definitely not a ton of cash flows. So you just have a market that values something different than traditional markets do. So what does that mean if you're an investor? The way we think about it is this team able to create their own narrative? So is what they're doing really ambitious? Is it novel? Is it unique? Is it like easily explainable? Could a group of people on Reddit talking about tokens get excited about this? That matters. Or like, is the team savvy enough to fit into like another narrative that comes along? Do they understand how these markets work? Because I think a lot of people come in and it's like, okay, I'm just going to build the most profitable protocol. I don't care about these retail traders. I'm just building for my customers. And you can do that, but ultimately those Reddit users are the end buyers of your token, so they matter. Or like, is this team just going to keep building long enough that the narrative will eventually come to them? And that's like grit and tenacity and just ability to execute. So it is similar, I think, to how like a seed stage SaaS VC would look at companies, but there are pretty fundamental differences.
Have you made any secondary market investments in tokens? What do the drivers tend to be for calls like that?
One way we look at what liquid tokens to buy is what products are teams in our portfolio using. So, for example, last year we established positions in Filecoin and Arweave, which are the two leading file storage protocols. And we just saw a handful of teams in the portfolio needing to store whatever kind of data related to like whatever their day-to-day business was. And some of them were using Filecoin and some of them were using Arweave. And it tended to be for kind of different use cases. Arweave, generally more teams building in NFTs. But we saw like increasing adoption there. And so we took positions in both of those. This cycle, some new layer one blockchains, like we see more and more teams in categories like DeepIn, which we're pretty heavily invested in using. And so we tend to view these positions, if we can invest in them in the private side because they're already liquid, we still think there's alpha there and we should have them in the fund. And so that is generally how we think about taking secondary positions.
As a venture fund, you're effectively playing a sort of chess. You're optimizing on multiple different dimensions because you have a product, your fund, which you sell to LPs and sold it successfully at the very beginning, raised a fund, and now you're investing. You're building a track record through your investments. You're building a return profile on the fund through the investments. And I imagine that the next step or some subsequent step will be to go back to those same LPs and others to potentially raise another fund, which I imagine requires certain inputs around maybe value creation, ability to deploy in the first fund, but also a cohesive pitch around why they should be allocating to this space in general, even apart from why they should be allocating to you specifically. What components of that hypothetical fundraising conversation you're having with an LP are most relevant when you're talking about why allocate to crypto, given what we've just been discussing around where returns come from, variability of time horizons, there's the short-term token-based return driver, more of a hedge fund style, active trading type approach. There's also a longer-term Filecoin and Arweave. I imagine you invest in those because you have more of a fundamental view that those are value-creating projects that will accrue token value over time. How do you balance those various components in such a dynamic market when you're looking to have a conversation with a potential investor in your fund?
We raised our first two funds in 2021 and 2022, and we didn't really necessarily have to convince a lot of people that crypto was like an asset class you should be investing in. There was a lot of general excitement. I'd imagine whenever it is we raise our next fund, that, there's probably a little bit more educations, maybe one way to put it, that we have to do. Look, I think we believe crypto is going to redefine all asset classes. I think there's a lot of cynical ways to look at the market. Some of them are right, but There's $120 billion in like US dollar denominated assets on chain. We talk to merchants in emerging markets that are like using these rails to just run their businesses more effectively. And there are tens or hundreds of thousands of people like that around the world. So it's obvious that crypto works for a lot of people. You look at what countries on earth have the highest crypto adoption rates. It's places with high inflation. It's Argentina. It's Turkey. It's places like that. So it's definitely not fair to just look at this whole asset class and say, oh, it's a bunch of gambling, because it very obviously is not. I think the data tells that. And I think then, how do you access that asset class? Our thesis is that the products that are market expanding, that's where the biggest opportunity is, because this market is still somewhat nascent. So we believe that new products that can get a new audience excited about crypto, earning crypto, buying crypto, spending crypto, or the infrastructure that enables them, those are the largest market opportunities. And I think that's led us to categories like DePIN, these decentralized physical infrastructure networks, earlier than most investors, because we saw new audiences getting excited about using Demo as a portfolio company where you can connect your automobile stream mobility data in real time out of the car to their marketplace and earn like your share of tokens for doing that. So that's kind of like where Lattice's angle is. On the return side, it's definitely taking longer and longer for companies to go public, which kind of definitionally like compresses your returns, which is like a longer time frame for every dollar you invested to get a dollar back. Crypto, as I mentioned, it's not like we can make money in a day. Like generally, we're taking a few year time horizon when we buy liquid tokens, but it's not a 12-year period like it is for something like Airbnb. So I think it's just a different asset class with definitely a different time frame than traditional venture, but probably a different return profile as well. I would never tell an LP, oh, you should put all your money in crypto. That would be a terrible investment strategy. And it is a very high risk asset class. It just is. But, you back test having Bitcoin in any portfolio, even 1% of your portfolio over the last decade, it like dramatically outperforms. And we believe this industry is kind of just getting started. I mean, the ETF got approved three or 4 months ago. So that's generally our framing. This is a high risk, can be high return asset class. You should have 1%, 2%, 3% of your AUM in it.
Final question for you before we wrap up. I imagine that you, given the diversity of this quote unquote crypto industry, you must talk to a whole range of very interesting founders who have different ways of thinking about where the opportunity is to build in crypto. What founder profiles tend to resonate most with you? Is it long-term visionaries that are looking to build infrastructure over 30 years? Is it a super culturally savvy individual that just understands the narrative, the vibe better than anyone else? Is it some combination of the two?
I think it really depends what you're building. If you're doing like really deep cryptography research, that's a different profile than if you're building like an NFT marketplace. You need to be a little bit cooler to build an NFT marketplace than do cryptography research. I mentioned DePIN earlier, these sort of decentralized physical infrastructure networks. Helium is a category leader. We've been investing in this category pretty heavily for the last few years. And I think what really excites us is when we meet industry participants from energy or something to do with restaurants or content delivery. And they just read about how crypto incentives it's just a capital formation innovation that makes certain businesses possible today that were not 7-8 years ago. And when we see like a light turn on in these founders' heads who've been working in telecom as an example for like a decade, and then they see Helium and it's like, oh, wow, I've been thinking about this other problem where I think this token-based capital formation could actually help solve it. That's really exciting. Those founders tend to be very ambitious. So that type of founder persona, specifically for DePIN businesses, we get really excited about.
Regan, I really appreciate you taking the time to connect today. You're an incredibly insightful guy.
I really enjoyed the conversation. Thank you for having me on.
Regan Bozman, thank you very much for joining us today.
Thanks again.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.